Welcome to RenEnergy.com, your renewable energy and sustainability platform. In an era marked by increasing environmental consciousness and calls for transparency, corporate sustainability reporting, CSR, has emerged as an essential practice for businesses worldwide. It serves as a key touchpoint for companies to engage with stakeholders, communicating their economic, environmental, and social impact and demonstrating their commitment to sustainable practices. CSR fundamentally revolves around the concept of triple bottom line: profit, people, and planet. It aims to balance financial performance, profit, with contributions to society, people, and sustainable environmental practices, planet. By taking all three aspects into account, companies can deliver long-term value to all stakeholders, including investors, employees, customers, regulators, and the communities in which they operate. In addition to the triple bottom line, CSR covers a wide range of topics, from supply chain management and labor practices to energy use and waste management. One of the most critical elements of CSR is the management of a company's carbon footprint, which has significant implications for the environment and climate change. Carbon emissions reporting is an important aspect of CSR. This involves calculating the amount of greenhouse gases, GHGs, a company emits and then reporting and working to reduce those emissions. With climate change becoming a more pressing issue, accurately measuring and reporting GHG emissions is becoming increasingly important for businesses. Moreover, this practice can provide valuable insights that can inform strategic decisions, improve operational efficiency, and ultimately, drive competitive advantage. The following sections will delve into the importance of calculating carbon emissions, introduce the standard tool for measuring and managing GHG emissions, outline the carbon calculation methodology, and explain how to integrate carbon emissions calculation into CSR. Part 1: The importance of calculating carbon emissions. It serves as a fundamental pillar in the planning and execution of various environmental initiatives. Here's why calculating carbon emissions is critical. 1. Establishing a baseline. An accurate and reliable calculation of carbon emissions allows companies to establish a baseline or a starting point. This baseline is essential to understand the present environmental impact of the company's operations. Over time, it enables tracking and measurement of progress in reducing emissions and helps the company evaluate the effectiveness of its sustainability initiatives. 2. Identifying hotspots. Carbon emission calculations can help identify operational hotspots, areas or processes that result in substantial emissions. These hotspots could vary across industries and individual companies. For a manufacturing company, it might be the production process, while for a logistics company, it could be vehicle emissions. Identification of these areas is the first step towards targeted, efficient emission reduction strategies. 3. Setting realistic goals. A clear understanding of a company's carbon footprint enables it to set realistic and achievable emission reduction goals. Targets set without a solid grounding in data may either be too easy, resulting in complacency, or too challenging, leading to unmet goals and morale issues. Quantifiable emissions data ensures targets are grounded in reality and attainable with effort. 4. Regulatory compliance. Many regions worldwide have introduced regulatory requirements for companies to report their carbon emissions. These regulations are expected to tighten further as countries strive to meet their commitments under international agreements like the Paris Agreement. Calculating carbon emissions accurately is essential to comply with these regulations and avoid potential financial penalties or reputational damage. 5. Communicating sustainability. Carbon emission data is a powerful tool in communicating a company's commitment to sustainability. Customers, investors, and the broader public are increasingly looking for companies that take sustainability seriously. Regularly reporting transparent and accurate emissions data can enhance a company's reputation, foster trust with stakeholders, and even provide a competitive edge in the market. Part 2. The Greenhouse Gas, GHG, Protocol. To effectively calculate and report carbon emissions, businesses often rely on a globally recognized tool, the Greenhouse Gas, GHG, Protocol. Developed by the World Resources Institute, WRI, and the World Business Council for Sustainable Development, WBCSD, the GHG Protocol provides comprehensive, international standards for managing, measuring, and reporting GHG emissions. The GHG Protocol classifies emissions into 3 distinct scopes, providing a complete picture of a company's carbon footprint. Here's a brief overview of each scope. 1. Scope 1, Direct Emissions. Scope 1 emissions are direct emissions that result from activities a company has complete control over. This includes emissions from combustion in owned or controlled boilers, furnaces, vehicles, and emissions from chemical production in owned or controlled process equipment. Essentially, any GHGs released directly as a result of a company's activities fall under this category. 2. Scope 2, indirect emissions from energy. Scope 2 emissions are the indirect GHG emissions from the consumption of purchased electricity, heat, or steam. While these emissions are a result of a company's activities, they occur at sources owned or controlled by another entity, such as a power plant. Therefore, while the company doesn't release these gases directly, it contributes to their release. 3. Scope 3, other indirect emissions. Scope 3 encompasses all other indirect emissions that occur as a consequence of a company's activities but from sources not owned or controlled by the company. This could include emissions from business travel, waste disposal, and even the use of sold products and services. Scope 3 emissions can often be the largest share of a company's carbon footprint, spanning across its value chain, but they're also the hardest to calculate and control. Understanding these three scopes of emissions is crucial for companies as they build their GHG inventories. It provides them with a comprehensive view of their carbon footprint, helping them identify opportunities for reduction, set realistic targets, and take responsibility for their environmental impact. Part 3, Carbon Calculation Methodology. Once a company understands the different scopes of GHG emissions, the next step is to calculate their carbon emissions. This process involves three main steps: identifying sources of GHG emissions, collecting activity data, and converting this data into carbon emissions. Step 1. Identifying sources of GHG emissions. The first step in the carbon calculation process involves identifying the sources of GHG emissions within the company's operations. This could range from the company's fleet of vehicles to the electricity used in office buildings. For manufacturing companies, the production process is often a significant source of emissions. Under the GHG Protocol, these sources are classified into Scope 1, direct emissions, Scope 2, indirect emissions from energy, and Scope 3, other indirect emissions. Companies must identify all possible sources of emissions within each of these scopes. Step 2, collecting activity data. Once the sources of GHG emissions have been identified, the next step involves collecting activity data related to each of these sources. This data typically involves measuring or estimating the volume of GHGs emitted from each source over a given period of time. For example, for a company vehicle, the activity data would be the amount of fuel consumed, while for an office building, it would be the amount of electricity used. For manufacturing processes, the activity data might involve the amount of raw material processed or the output produced. Step 3, converting activity data to carbon emissions. The final step in the carbon calculation process involves converting the activity data into carbon emissions. This is typically done using emission factors, which are coefficients that convert activity data into GHG emissions. Emission factors vary depending on the source of the emissions and the type of GHGs being emitted. For instance, burning natural gas in a boiler has a different emission factor than burning gasoline in a car, and different gases, such as carbon dioxide, methane, and nitrous oxide, have different global warming potentials, GWPs. By multiplying the activity data by the appropriate emission factor, companies can estimate their GHG emissions. This information can then be used to generate a GHG inventory, which is a key tool in managing and reducing a company's carbon footprint. Part 4, Integrating Carbon Emissions Calculation into Corporate Sustainability Reporting. Integrating carbon emissions calculation into corporate sustainability reporting, CSR, is a vital step towards mitigating climate change impacts and enhancing corporate sustainability. The following steps outline how to achieve this integration. 1. Developing an inventory management plan. An inventory management plan, IMP, is a strategic blueprint that outlines the company's process for collecting, managing, and reporting GHG data. The IMP should clearly define roles and responsibilities, identify key emission sources, outline data collection procedures, and establish methodologies for calculating emissions. This plan will serve as a reference and guide for managing GHG emissions, ensuring consistency and accuracy over time. 2. Ensuring data quality. Data quality is crucial for accurate emissions calculation and reporting. Companies need to ensure the reliability and accuracy of their GHG data. This involves implementing rigorous data collection processes, cross-referencing multiple data sources, and regularly validating and verifying data. Companies may also consider third-party audits to enhance credibility and trust in their GHG data. 3. Setting and tracking targets. Once a company has established its GHG inventory, it can set targets for reducing emissions. These targets should be specific, measurable, achievable, relevant, and time-bound, SMART. Companies should also implement systems to regularly track progress towards these targets, which can provide valuable insights and help drive strategic decisions. 4. Regular reporting. Reporting is a crucial component of CSR and GHG management. Regularly publishing GHG emissions data can enhance a company's transparency and accountability, boost its reputation, and help attract investors and customers. These reports should be clear, comprehensive, and accessible to a wide range of stakeholders. By integrating carbon emissions calculation into CSR, companies can gain a clear understanding of their environmental impact, set and track meaningful targets for reduction, and communicate their sustainability performance to stakeholders. It is a vital step towards more sustainable and responsible business practices. Conclusion: the role of carbon emissions calculation in CSR. As we navigate the complexities of the 21st century, the role of carbon emissions calculation in corporate sustainability reporting, CSR, has never been more significant. Amid growing awareness about climate change and increasing regulatory pressure, accurately accounting for carbon emissions has become a business imperative. By quantifying the carbon footprint, companies can gain a comprehensive understanding of their environmental impact. It enables them to identify hotspots, establish a baseline, set realistic reduction goals, and monitor their progress over time. Furthermore, it empowers them to communicate their sustainability efforts transparently, contributing to building trust with stakeholders, be they investors, customers, employees, or the wider public. However, calculating carbon emissions is not a goal in itself. It is a means to an end, a tool that facilitates the transition towards a more sustainable and resilient business model. With precise data at their fingertips, businesses can make informed decisions, innovate, and strategize their operations and processes in ways that not only reduce their carbon footprint but also add value to their bottom line. Moreover, by integrating carbon emissions calculation into CSR, companies demonstrate their commitment to a sustainable future. They not only fulfill their environmental responsibilities but also contribute to global efforts against climate change. In this way, carbon emissions calculation in CSR holds the potential to drive systemic change, transforming business operations, catalyzing industry-wide shifts, and shaping a sustainable future for all. Ultimately, carbon emissions calculation within CSR underscores a company's commitment to environmental stewardship. It is a tangible action that signals a firm's readiness to step up and take responsibility for its environmental footprint. In doing so, it paves the way for a more sustainable, resilient, and prosperous future. Thank you for choosing ReneEnergy.com as your go-to source for all things renewable energy and sustainability. With our YouTube channel, we explore the latest developments and innovations in the field, including hydrogen fuel cells and the use of AI and machine learning to optimize energy consumption. If you're ready to take the next step towards a cleaner, more sustainable future, visit us at ReneEnergy.com and discover the many ways we can help you transition to renewable energy. Thank you for watching and subscribing. Stay up to date on all the latest news and insights by subscribing today.